what you're hearing from the low end, from the lower end of people who are earning money, is that they are tapped. Inflation is catching them, especially if you're a senior, you're living on a fixed income. That's going to be a serious issue. And while you might be concerned about a recession from that, you might take the Fed into thinking, OK, what we really have to do is stop inflation, because those are the people who get killed by inflation most.
There are no good answers here. The reality is the Fed was far behind the curve and stuck to their version of forward guidance for far too long. So the aircraft carrier they're trying to pull a soft landing on is in very rough seas. And as you show, recession is a more and more likely probability. Ultimately, the Fed has a track record of continuing to raise until there really is a clear slowdown. And I expect that to occur, although after this meeting, at a slower pace.
Let's talk about earnings again. Just what we saw last night, Microsoft and Alphabet, both of them missing expectations, but not by as much as some people had feared, I guess, especially in the case of Alphabet. It didn't get hit as hard by the advertising slowdown as Snap and Twitter had earlier in the week. Does that tell you that the market has priced in a lot of this, or do you think that this is a temporary respite?
I think the market's priced in quite a lot. Here at Thornburg, we're finding a lot of opportunities, actually not just in equities, but across some beaten up fixed income. That said, the idea that we're not going to have a choppier market when really bellwether names, maybe you might call them the new utilities of tech, report misses, it's going to be tougher. So I think that those companies and the market had discounted a tougher quarter. Microsoft, it's been a long time since I've seen a miss from Microsoft. But the idea that these companies and names can sustainably rally before we get the last or the worst of the earnings news, I think is going to be a tough sell.
So where do you see opportunities? What do you like?
Actually, we're looking at some financials, not just in the United States, but elsewhere. Names like NN Group in Europe. Actually, Citigroup has a nice franchise. Those names we believe are well reserved for potential further challenges. And then fixed income, we see a lot of opportunity across some, let's call it cream of the crop corporates, double B high yield. You're seeing yields that are well over double what they were a year ago. And in an environment where inflation will eventually slow, those are names that we think will add income to investors' portfolios for some time. But it's really all about balance here.
When you talk about fixed income, are you talking treasuries or are you talking about corporate?
All of the above. Treasuries are better. The idea that a 10-year at 280 is going to make anyone's quarter or year or anything is a little bit tough sell. But add on wider corporate spreads and add on the fact actually that treasuries here can actually provide ballast for portfolios. So to the extent we continue to get choppy markets, what you're seeing in the last, say, couple months is treasuries are able to provide what they used to provide, which is some balance in a portfolio and some small level of income. But ultimately, the opportunities are actually in things like ABS and corporates.
Shepard Smith here. Thanks for watching CNBC on YouTube.